Hello and welcome to Portfolio Matters. We are back from our long summer break. I hope you also have got away and are coming back refreshed to these volatile markets. And we have a packed program today where we basically summarize a month's worth of economic data. So be prepared for a long one. But before we get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. And listeners should be aware that we will be discussing securities that we own or have financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Okay, first of all, the news this week. Well, the Bank of England Governor Andrew Bailey has indicated that the UK may be close to the peak of interest rates. Now, reminder, the markets are pricing in 2 further interest rate rises in the UK. Andrew Bailey was pushing back on that, and Hugh Pill, the Bank of England's chief economist, also said in a speech that he preferred a rate outlook which was higher for longer rather than much higher for shorter. So the Bank of England is indicating that unless the data exceeds their expectations in the form of wage growth or inflation, they are likely to pause when they meet again later this month. Sterling fell as the market adjusted to a lower UK interest rate outlook. Now, the ONS has revised higher UK growth over the period 2019 to 2021 by an astonishing 1.8%. And they say that the UK economy has now fully recovered from the pandemic period, and we are no longer the laggard in the G7. I have a chart for you in a minute. China continues to struggle and has announced measures to stimulate its housing market, including cuts to existing mortgage rates and lower down payments for house purchases. And the big news of the week was that OPEC have extended their production cuts to the end of the year, sending Brent back over $90 a barrel for the first time this year. And that will feed through to higher inflation in the coming months. Some charts relating to the news. Well, the ONS revised up its estimates for UK GDP growth. So the solid line is previous estimates, where we were the laggard in the G7. The dashed line is where they think we are now, solidly middle of the pack. Now, the details of the revisions were absolutely astonishing. So the gross value added for basic iron and steel manufacturing for the period was revised from plus 56% to minus 66%. So the size of these revisions was amazing. And frankly, it does rather undermine your confidence in the whole statistics measuring framework. If they got it that wrong the first time, what's to say that their current measures are that much more accurate? Now, the market is pricing in a 95% chance that the Fed will pause next week, actually the week after. But it's then expecting the Fed to start cutting rates during Q1 next year. But despite that, bond yields have been rising strongly over the last month. Much more on that later. Turning to China, this is a chart of China's top 100 property developers, their sales, and it shows that over the last year, they're down, 30%? Having previously been down 60% year on year. Chinese property market shows little sign of recovery. And in China, when you don't like the data, you just stop reporting it. So this is Chinese youth unemployment to June. They didn't like this trend in the data, so they've simply stopped reporting it. And on to this month's economic data. So this is the highlights of the economic data since we last reported about a month ago. Stuart.
Okay, looking at the UK first. Here we go for UK house prices, obviously a subject of perennial interest to everybody. And a pretty bad number in August, down -1.9%. And I would just add that I think the other measures, including the nationwide measure of house prices, showed a similar level of downward movement. Looking at that year on year, now some pretty big falls, -4.6 year on year. Obviously, that's nominal. So in real terms, they've come off a bit more. So affordability might finally begin to improve. And talking of the overall number, 285,000 is apparently now the UK average house price. Though I think that might be the house prices on which Halifax makes a mortgage. So right. I suspect that they're probably biased down a little.
Yeah. When you look at this, then the dip in house prices have really been very small.
UK mortgage rate 7.85% now. No sign of that coming off, and obviously we can all imagine what that does, particularly for first-time buyers.
Yeah. So the thing is, when you look at average house prices and then multiply them by the mortgage rate, first-time buyer affordability is just been destroyed. You can have very high house prices when interest rates are really low. And, if you look at the period since 2000, then you've seen a huge acceleration in house prices. And
I think that's absolutely right, which is why, as a buyer, I think you've always got to look at the price to earnings ratio as well as the affordability ratio. Otherwise, you're going to get sucked into thinking you can afford a bigger house than you really can.
Yeah. So various house builders have reported, big drops in sales and drops in housing starts. And essentially, the UK housing market just does not work at these mortgage rates.
Construction orders, unsurprisingly, I think that this isn't just housing, but all construction down almost 18% in Q2 against expectations of actual of a rise of 8.5%. So a big number. Construction output year on year still actually up 4.6%. Somewhat surprising to me.
Well, I think a lot of the flip side of all the pandemic stimulus and very low interest rates was that there was a lot of investment went into construction projects, which are still ongoing. Interest rates work with long and variable lags, and that fall in orders will affect future projects, not current ones.
Looking at the very big picture, UK GDP month-on-month estimate, so presumably subject to quite a lot of revisions, but June came in at plus 0.5%, with May minus 0.1%. So on this measure, at least, the economy not doing too badly.
Yeah, good month, June, but obviously that is behind us.
Looking at that year on year is only plus 0.9%, which the government will say is better than people have been talking about, but it is still pretty weak, really. UK average weekly earnings, including bonuses, year on year now up 8.2%, and I believe previously the number for May was 6.9%, as that's been revised to 7.2, if I'm getting that the right way around, Keith. So still a lot of wage pressure in the UK economy.
Yes, you got that absolutely right, Stuart. Almost called you Richard there. Previously they estimated May's year-on-year growth at 6.9. They've now upgraded 7.2, and then June 8.2, massively above expectations. So wage pressures were still very high in June.
Excluding bonuses, up 7.8%, and again the number for May revised up from 7.3 to 7.5. So if you've got a job and you've got your mortgage fixed for 5 years, you're actually sitting quite pretty. Though, of course, as we know for the UK, most people's mortgages are not fixed for very long. Wage inflation does appear to be moderating, however, if you look at the latest PAYE data from HMRC, though we must remember that earlier this year they had a massive revision to their data, didn't they? So how much we can really rely on this data yet, I think we need to give it a few years first before we really trust it. UK unemployment rate, now that does appear to have bottomed, doesn't it? So up from a low of about, what's that, 3.6 to 4.2 in June. So that looks like it's very definitely turned for the worse.
Yeah.
Worse for the economy, worse for people. Good news for the Bank of England.
Yes, that's right. But this should bring down wage inflation, and it's rising quite quickly. Now, I have been listening to podcasts talking about the Great Resignation during the pandemic. And of course, people resigned during the pandemic and retired because they thought that, they had very low interest rates, increased asset prices, and they thought they had enough to live on. Since then, inflation has really eroded living standards, and a lot of those people are now coming back into the workforce.
Yeah, well, one technical point on that, of course, is that many UK pensions, their annual rise is capped at 5 or 2.5%. I'm talking here private sector pensions, not the famous triple lock on state pensions. So, of course, you're gradually going to be squeezed by that sort of cap on your pension increase. Okay, turning to UK employment change month on month. Well, there was a fall, 66,000. And again, I think you can see some evidence of emerging labour market pressures there. That number has fallen quite a lot this year.
Yeah, and that's back in May.
Oh, right. Yes, a little while ago. Yeah.
So, adding to evidence that the UK employment market has been slowing actually for a while now.
UK claimant count, again, the same picture, the scale, of course, totally distorted by COVID, but claimant count up 29,000 in July against expectations of a fall in the claimant count. So whilst it may not be strong, there does appear to be a clear evidence of a turn in the labour market, and the revisions to the June data, I think, are also in the same direction, i.e. weaker employment. And turning to the UK HMRC payroll count, again, I'm a bit dubious about these numbers. They came in at a growth of 97,000 for July, but if we look at June, it's been massively revised from a fall of 9,000 to growth of 47,000. And given that the history we've had with this data series, I think, not even a pinch of salt will do. We need a sack of salt.
Yeah, I completely agree. I think we report these live. We should probably report them with a 1 month lag because the revisions are so enormous. Earlier in the year, they reported, I think it was in April, a fall of 100,000. Yeah. And then they revised that to +9.
Yeah. Yeah. UK CPI year on year, the headline measure, this looks quite encouraging, from a peak of about 11% to 6.8% in July, which absolutely met expectations. So that on the surface looks encouraging. However, I think we're going to go on to the core in a second. Just converting that headline number into the month on month, and prices fell by 0.4%. So that will obviously be bringing the headline rate down pretty quickly.
Yeah. Now, that was caused by the end of the energy price guarantee, and that was always going to happen. So, that's a one-off.
Right, finally getting on to the core CPI, which is a much less pretty picture. Expectations had been for 6.8%, came in at 6.9%. So the absolute level is not encouraging. And I think the trend, if anything, is still upwards. It's not a very good picture at all.
Yeah, what I'd say though, Stuart, is if you look at the last two pieces of data, annualized, those are pretty good numbers. So
yeah, that's true. Yeah,
it's actually the inflation earlier in the year, and the change in the incremental months that is causing the persistence of core, if you analyze recent data, it's not too bad.
Okay, yeah. Our friend RPI year on year showing a more exaggerated picture even compared to the CPI headline, coming down from a peak of over 14% inflation to 9% in July, which I think is important for anyone who happens to hold any index-linked gilts. And I think we know someone like that.
Yeah, sadly we do.
UK retail sales year on year down 3.2% against expectations of minus 2.1, so pretty poor number. And June also revised worse from minus 1% to minus 1.6%. Keith, do we know if this is pounds? Is this value or volume?
I think this is real. So this is
volume. This is
volume, yeah.
Yeah, because obviously that's now been negative since the spring of 2022. So you're beginning to compound negative numbers on negative numbers, if you see what I mean. Retail sales month on month, pretty painful, minus 1.2% in July.
I think that was affected by bad weather in July. There has been a bit of a bounce back in August, I believe.
UK PSBR month on month, not too bad a number actually, minus 3.5 billion. Obviously it bounces around quite a bit. We'll have to see, but obviously with tax thresholds being frozen in nominal terms, you'd expect a fair bit of fiscal drag over time. And
yeah,
going up, what was it, sort of 7-8% nominal, but tax thresholds flat. That's going to drag a lot more people into paying more and more tax.
No, I agree, Stuart, because I was puzzled by this. This is a big beat, actually. And I saw no commentary about what's caused that. But I think fiscal drag is probably the best explanation.
UK CBI industrial trends for orders weakening to minus 15 against expectations of minus 13. Not a particularly happy picture. Not awful, but going the wrong way.
Yeah, but you notice how bad it's been for a long time. I mean, minus 15 is actually not a terrible number. I mean,
yeah. UK CBI distributive trades. This one really is a very painful number. Minus 44 against expectations of minus 32. So that is not very encouraging for outlook for output.
Well, that's retail. And you notice how volatile it is. And I wonder if they've just slightly overreacted to the bad numbers in July.
Well, I guess, I mean, if you look historically, it seems to become more volatile. I don't know if this is to do with just-in-time fashion, perhaps.
Yes.
Big surges and big, putting on the brakes.
Yeah, good point.
UK CBI consumer confidence, not too bad at all, actually. Minus 25, a bit like our comments on European consumer confidence, perennially negative, but a lot less than it has been earlier in the summer.
Yeah, I wonder though. Oil prices are rising again. Petrol prices are rising again. I think this could turn back down.
The S&P manufacturing PMI for the UK. This looks awful, doesn't it? This is coming in at 43, actually fractionally better than expectations of 42.5. But look at that chart. I mean, aside from the pandemic, this is the worst number since the global financial crisis.
Yeah.
Looking at services, that too has weakened. Not as bad as manufacturing, but it's now below 50. So fractionally in contractionary territory, 49.5.
Yeah, this is a big miss. So, the UK economy is mainly services these days.
So putting together manufacturing and services, we get the composite, which is now in contraction at 48.6. Yeah,
now it was in contraction actually in late 2022, and then it bounced back. And so that doesn't, it doesn't mean that we can't have a bounce back. But I think that the lagged effect of interest rate rises means that this time it is unlikely to bounce back in the way it did, late last year, early this year.
Yeah. Right. There's a very strong correlation between the PMI that we've been looking at and UK GDP growth. So the falling PMI really does suggest that the UK is falling into a recession. And here we have a chart from Chris Williamson on Twitter. So not particularly encouraging outlook. And that, looking to the upside, would mean that price pressures completely evaporate and inflation should come down in a very standard economics textbook type way.
Yeah, he's forecasting that CPI will come down to 4% by the end of the year. Let's hope he's right. I mean, I think that's aggressive, but that'd be great.
Looking at UK construction PMI, not too bad actually. Manufacturing may be weak, but construction's looking all right, coming in at 50.8, pretty flat most of this year. Although the aggregate construction PMI might be okay, but the housing component is awful, which I think Keith has already referred to for the UK house builders. So we can see commercial activity, civil engineering and housing components of overall construction PMI, and it's housing really that's particularly weak. UK, a different cut on retail sales. This is from the British Retail Consortium, I think that is. Actually much better than expected. This is nominal, up 4.3% year on year. So 4.3% nominal up, but depending on which inflation measure you want to take off, that has still a pretty big cut in real terms. So summary of the UK. UK CPI inflation fell in line with expectations. It's now at 6.8%. Core CPI was steady, and as Keith's been highlighting, the recent numbers were only 0.3 month on month, so some reason for hope there. And if inflation is falling, the Bank of England may not be desirous of increasing interest rates hereafter. Wage growth beat expectations, 8.2% year on year in June, but that is too high to be compatible with the Bank of England's target. Hence, Hugh Pill's view that we may just have to have higher rates for longer. The unemployment rate rose in June, and the claimant count rose again in July. Most of the indicators on that side of the economy do appear to be suggesting slowing. Consumer confidence rose in August, as did retail sales in nominal terms. And the UK composite PMI is now below 50, suggesting the economy is shrinking. So bottom line, UK is slowing towards a recession as higher interest rates begin to bite.
Thank you, Stuart. Right, on to the EU. Now, we had the EU GDP growth numbers year on year for Q2, and the third estimate was out this week, and they revised it down again. So the second estimate was 0.6%, and now estimated at 0.5%, down from Q1. Quarter on quarter, the previous estimate was 0.3%, it's now 0.1%, but they did revise up Q1 growth from 0% to 0.1%. But the picture is of an EU economy which is pretty close to stagnation.
Keith, one small point of interest. On one of my little trips over the summer, I was in Ireland and speaking to some people there, and they were referring to the very strange shape of the Irish economy as far as the statistics at least is concerned. With all these sort of international companies, pharmaceutical companies, tech companies, there basically to do a tax arbitrage. But it totally distorts Ireland's economic data. But even though Ireland is such a small part of the EU, it also is enough to distort EU data. And if you try to exclude these huge numbers, it actually suggests the European economy didn't grow even a little bit and did actually shrink.
Because I saw Ireland's GDP per capita compared to the UK's, and it's absurd.
Yeah,
like Irish are like a third wealthier than the British are, and it's just as you say, the data is being distorted by these huge multinationals doing this tax arbitrage. And on to industrial production for July, which beat expectations. It was down 1.2% year on year against expectations it would deteriorate to 4.2%. So EU industry is not doing well, but it's not doing as disastrously as people expected. Month on month, it actually grew 0.5%, although the June number was revised down. Construction output fell in July against an expectation that it would rise by 0.7% year on year. The construction sector in the EU is not doing well. Now, we also had the monthly Eurostat surveys, and economic optimism in the EU fell to a new low for this cycle, missing expectations. Industrial sentiment gets worse and worse. Consumer confidence, having risen steadily from catastrophic lows, is fading again. And sadly, inflation expectations are rising as oil prices rise. Services sentiment, crucial to the EU economy, is also fading. Good news is selling price expectations are towards their lows and not really rising much. Now, we also had EU inflation numbers for August, and sadly, they missed expectations, coming in at 5.3%, unchanged from July. Month on month, that is a bad number, up 0.6% against expectations of 0.3%. Core CPI ticked down slightly in line with expectations, but still way too high at 5.3%. And the PMIs, well, the manufacturing PMI bounced slightly to a still awful 43.5, deep in contraction territory. The bad news for the EU economy was the services PMI massively missed expectations. That is a big miss. It's expected at 50.5, it fell to 47.9. And this week we had the final estimate, and it had been revised down to that number from, I believe, 48.6. So the more they look at the data, the worse it got. And that means the composite fell further in August to 46.7. The EU economy looks like it is already in recession. Construction PMI has been below 50 for a long time now. So, summary for the EU. The EU economy grew by a rather lackluster 0.5% year on year in Q2, but inflation is still too high and not falling as fast as the ECB would like, at 5.3% in August, and crucially, month on month, up 0.6%. Core fell, but only to 5.3%. The ECB will not be happy. The Eurostat surveys were uniformly terrible. Economic optimism, industrial sentiment, consumer confidence, and services sentiment all fell in August. And the worst data point for the EU this month was the PMIs, the services PMI, which fell to 47.9. And the composite, therefore, fell further into contraction at 46.7. Bottom line, EU economy appears to already be in recession and falling further into it, even as Christine Lagarde contemplates further rate rises next week. US, Stuart.
Okay, well, after the gloom of Europe and the UK, I'm expecting some better numbers here. Turning to retail sales month on month, we've got them up 0.7% July against expectations of 0.4. So good stats there. Converting that into year on year, it's up 3.2% against expectations of 1.5. So again, reasonably encouraging. Housing starts. Well, this hasn't fallen quite off the cliff as we expected. given the rise in interest rates. We've covered this in previous editions of the show. Housing starts for 1.45 million annualized in July, which was bang on expectations. But I think that the big thing to me is if you look at that chart, you don't see the big step change down that we saw after the global financial crisis.
Yeah, or in the UK. In the UK,
Yeah.
we know that house builders are really stepping back. In the US, they're not.
Looking at that month on month, it was up 3.9%, though that is after minus 11.7% in June, which itself was after plus 17.4% in May. So some volatile numbers, but I think he's painted the big picture there, which is the US housing market in terms of starts has not collapsed in the way that we expected. New home sales showing sort of the same picture. Starts are being converted into sales. They're seemingly therefore not a big build of inventory. The new housing starts are being justified by home sales. It's not just a question of continuing to build on plots which constructors had bought over the previous few years. By now, they're building on fresh plots that they've committed to.
Yeah, amazing. Given we'll show you later, US mortgage rates have absolutely shot up, but people are still buying houses and house prices have risen year on year. So affordability is awful, but people are still buying.
New home sales month on month up plus 0.4%. So of course a bit of a volatile number, but not bad, reasonably consistently through 2023. The US Conference Board leading index is looking reasonably chirpy. Sorry, it isn't. The blue line is the leading economic indicator year on year, and now it's actually forecasting recession, which we haven't seen, which is the grey line. Though being a leading indicator, we would expect it to be ahead, as it was in the early 2000s recession and in the GFC. So if its historic power continues, then we would expect to see weak GDP numbers, but we definitely haven't got them yet.
Absolutely.
Well, this is another way of looking at that leading indicator. The red bar blob indicates when a recession signal has come from the leading economic indicator, and it has successfully forecast recessions in the past, and it has been leading. Though one would say that it's given a very early signal this time, which hasn't come through yet, but
yes,
it has got a reasonably good record.
Yeah. Not the only person or indicator that's been way too early this cycle.
Yes. Looking at the PMIs from manufacturing survey from S&P, 47.9 in August against expectations of 49.3, so not great. Services weakening from 52.3 down to 51 in August, a bit lower than expectations and approaching that 50 level between expansion and contraction. So PMI is not looking that great.
Viewers, bear this chart in mind, because once again, we have a huge discrepancy between the ISM, which we will show you in a minute, and the S&P Global. S&P Global are reporting that there was actually a sharp deterioration in services activity according to the PMI in August. The ISM has it the other way round.
Right. Well, if we put the S&P ones together into the composite, that's barely scraping above 50 now.
Yeah. According to the S&P Global PMIs, the US is approaching recession.
US durable goods orders month on month fell pretty heavily, minus 5.2%, after June number of plus 4.4%. US job openings. Well, this is interesting data, isn't it? This is falling very fast. And job opening, the US labor market has been the real source of strength. But this is a very worrying sign for US job market. Now, I say it's interesting because it's falling very fast. It looks awful. And yet the absolute level is still much better than pre the pandemic.
Yes.
The quits ratio, the famous jobs quit statistic, that's also showing a similar sort of pattern. People not quitting, implicitly not thinking they can go elsewhere for a better job or better pay. So some pretty interesting signs of weakness in the heretofore strong US labor market.
Yeah, and in July, that means the quits rate is back to its pre-pandemic levels. So signs of labor market normalization.
US GDP quarter on quarter annualized. We're in America, so it's always annualized data. 2.1% for Q2, revised down from the first estimate of 2.4%. So again, not a great direction of travel. US PCE quarter on quarter annualized, showing much more reversion to what the Fed would like, only 2.5% in Q2.
Yeah, this is great. Personal consumption, expenditure, inflation, getting back towards target.
Yeah, because that is the measure they target, isn't it?
Yeah.
Core PCE quarter on quarter annualized, still at 3.7%, however, though that was weaker than the expectations of 3.8% and much weaker than Q1, which came in at 4.9%.
Yeah, still not great.
PCE inflation year on year bounced a bit up to 3.3% in July, though that was bang in line with expectations.
Yes, I should point out that this is the monthly number. The previous numbers were the quarterly data.
Yeah. So again, month on month, 0.2% in July, bang on the same from June, also 0.2%, which is perfectly decent, acceptable number.
Yeah, if you look at the more recent data, that looks bang on 2% target. Nothing to worry about.
Core PCE year on year, 4.2%, again, meeting expectations in July. US unemployment rate, right. Well, here expectations have been for unemployment to remain at 3.5%. It actually ticked up to 3.8%. So worse for workers, but actually, I'm sure the Fed would be secretly rather happy with that.
Yeah, absolutely. And that is a big change in 1 month.
Yeah. US participation rate. I suppose this is a similar story to what you're talking about in terms of the Great Resignation, Keith, that participation rate coming back to pre-pandemic levels, 62.8% in August. US non-farm payrolls increased by 187,000 in August. But perhaps the more interesting data was that July's number was revised down from 187,000 to 157,000. And as we've discussed previously, these revisions to the data, thank you, Keith, are themselves predictive of where we are in the economic cycle. And you get this rhythm, this cycle of underestimating and overestimating jobs growth. And here, jobs growth is being overestimated. And as the numbers are revised, a somewhat gloomier pattern emerges. So summarizing things in the table here, across the year to date, the original non-farm jobs were 2.052 million, and the revised, they were only 1.722 million. So cumulative loss of apparent jobs of 340,000. But crucially, that happened in every month. There was an overestimate of non-farm job creation.
Yeah, thank you very much to Draw It for sending us this from our Discord.
The number of full-time employees in the US actually fell by 85,000 in August. And this, I think, illustrates the issue with the labour market. You do have to be careful with the data. When you start looking at the unemployment rate, it is one number divided by another number. So it's also a question of how many people are looking for work, how actively they're looking for work. You look at a few measures.
A plea for information from our viewers, actually. So last month, we know that in July, the US lost over 500,000 full-time jobs. This month, it lost further 85,000. Now, if you dig into the BLS data, where I got this from, essentially, you see that last month, in August, they're talking about net non-farm payrolls of 187,000 jobs created. But this data shows that there was a loss of 85,000 full-time jobs. And if you look at the part-time jobs, they only rose by 32,000. So how do you get to a number of 187,000 jobs created? I don't get it. It must be something in the way they are reporting the data. If anyone knows, please can you get in touch?
Well, as Keith has just touched on, temporary jobs are also an interesting stat. Obviously, temps are easier to hire and fire, and all employees for temporary services has been falling now since 2020, the beginning of 2022. Not a good sign. So temporary employment has fallen for much of the last year. Is it a leading indicator or a contemporaneous one? What do you think this chart really shows?
People. The thing is, Stuart, everyone talks about how temporary jobs are a leading indicator for the employment market because the first people you let go are temps. But then, it's been giving quite a negative signal for what? 18 months now. But actually, I think it's spot on because we know actually the labour market has been weakening over that time. So, I'm with it being a leading indicator. And what it's showing is, steady, slow decline in the US jobs market.
Another version looking at the same issue. This is from LinkedIn hiring rate, showing a pretty similar pattern actually to that the temps data there, falling over the past year pretty consistently.
But crucially, it's below 1. So it's showing that hiring rates are now below their long-term average.
So I think that this is quite fundamental, isn't it? But we've said over the past year how strong the US labour market is, but we've got many indicators now saying that really, you need to change your assumption on that now. It's really rolled over.
Yeah. And crucially, the momentum looks negative.
Okay, back to the traditional data, US construction spending month on month. Both June and July, pretty good numbers, 0.6 and 0.7%. Okay, right, so here we are, the ISM manufacturing. So we had S&P Global measuring a very weak situation. The ISM, not too bad at all, 47.6, and crucially bouncing after some weak data earlier. Manufacturing new orders, not bouncing so much in the past month, coming in at 46.8, but not being in too terrible a territory. Right, ISM services PMI, well, here's a pretty good number, isn't it, compared to S&P Global, 54.5, not too bad at all. If 50 is the border between expansion and contraction. So, right, we have methodological issues, and it's unclear what's going on.
Yeah, so reminder, this is the S&P Global Services PMI, declining and heading towards 50, which is contraction, and the ISM heading absolutely in the opposite direction, and actually a pretty decent number. Now, we had this earlier in the year. If you look at the period beginning of 2022, just before it, you'll see there's a massive difference between the two. Now, I think you would have to say the S&P Global was a better guide because the ISM reverted to the S&P Global. But, all we can say at the moment is the two are very different.
Right. During the GFC, the ISM services indicator was actually a rather poor guide to the state of the economy. It didn't actually begin to roll over until Lehman collapsed. So the idea here is that it's a rather contemporaneous signal rather than a leading indicator. Is that the concern?
Yeah, well, during that period, going back to 2008, Do you think the economy completely fell off a cliff like that when Lehman went bust? I think it was deteriorating steadily over that period. And so the ISM just seems to be, I don't know, have an optimism bias in it. And so the yellow line is current.
Yeah. ISM services new orders, again, a very positive number, 57.5 against expectations of 54.
Yeah. And essentially, if you look at the ISM services, they would say, actually, the US economy is bouncing back. It looks fine.
US factory orders month on month, so not surveys, but hopefully harder data, minus 2.1% in July, but that was after a June number of plus 2.3. The US IBD Economic Optimism Index bouncing from around 40 to 43.2.
Yeah, not great.
The Logistics Managers Index has bounced, but difficult to know how to read this. Again, is 50 the traditional boundary between expansion and contraction?
Well, I think this is the whole history of the Logistics Managers Index. And previously, it was an all-time low. So it's bounced, but it's still not a great number. And it is volatile. You see that it's done this before.
Yeah. US Johnson Redbook retail sales year on year. That's quite a bounce. I think we saw that in the official stats as well, didn't we? 4.1% after last week's 4.2. So quite a high frequency data, which hasn't reverted. It's been reasonably strong for a while, for a few weeks now.
Yeah, and that suggests actually August was a very good month for US retail sales.
Okay, the mortgage rate, I think we've covered this extensively in the past, very high. This is the conundrum. Why is the US housing starts so strong given what's happened to mortgage rates? Implicitly, I guess it's not people with mortgages who are buying the houses.
Yeah.
7.2%.
Now, I've done quite a lot of reading on why the US housing market remains so strong. And the bottom line is that nobody with an existing house and a mortgage they took out years ago from a Freddie Mae, sorry, what is it?
Yeah,
Fannie Mae and Freddie Mac at 2.5% is willing to sell their houses and then have to give up that amazing mortgage. So existing home sales have collapsed, and if you want to buy a house, that means you have to buy a new home, and so new home sales have held up very well. What puzzles me is we know, moving on to the next chart, that the mortgage market index keeps on falling, which means that very few people are taking out mortgages, which implies that all these home sales are being bought by people who are cash rich. Now, eventually, surely you have to run out of cash rich buyers.
You would think so. It doesn't quite add up, does it? Right. Stats on the US labor market now. US initial jobless claims came in at 216,000. But I think more importantly, it's the trend that we've seen over the past few weeks. If you want to be worried about the US labor market, I think you can see a trend there.
It seems to be doing just fine. Jobless claims are declining, not rising.
Oh goodness, I've got this the wrong way around, haven't I? Yes, you're absolutely right. Continuing jobless claims, no real change in direction here. And 1,684,000 this week. Little change on the previous week or the past few months, really.
Now, some subtlety here. So the chart we just showed you is seasonally adjusted. And the concern is that the seasonal adjustment process has been distorted by COVID and the massive changes in the claimant count over that period. And so on this chart, the dotted line is continuing claims seasonally adjusted, and the solid line is continuing claims versus the pre-COVID average for the year. Okay, so what you then see is that continuing jobless claims have moved from being below average for the year to above average for the year when you use the data just for the period 2018-2019 and exclude the pandemic period. So that suggests continuing claims are actually rising more than would be expected from the seasonal pattern in the pre-COVID period. However, when you look at the absolute numbers, so here, the red line is not seasonally adjusted, and the blue line is seasonally adjusted. Actually, there's not that much difference between the two, and you can't really see any sustained rise in jobless claims.
So in summary, the US housing market and the construction sector remain resilient. Housing starts and new home sales continue to be strong. US retail sales rose up 0.7% month on month in July, and the Johnson Red Book numbers also back that up. So the US consumer for the moment remains resilient. However, the JOLTS job openings did fall sharply in July, and the quits rate is back at pre-pandemic levels. So some forward-looking indicators give them cause for concern. Non-farm payrolls beat expectations, coming in at 187,000 in August, but full-time employment fell a further 85,000. There's a big difference emerging between the S&P Global and the ISM PMIs. We don't really know what's happening there. So bottom line, the US economy continues to be resilient, but the outlook remains highly uncertain. There's contradictory data out there for sure.
And on to China. Thank you, Stuart. So this is the NBS manufacturing PMI. Reminder, NBS stands for National Bureau of Statistics, so it's official figures. And that showed manufacturing recovering slightly in August, but still in contraction territory. Non-manufacturing declined from 51.5 to 51, missing expectations. So even the official statistics are showing that the Chinese economy ain't doing so great. And that meant the general did slightly better than expectations at 51.3. You wonder how much propaganda is in this, frankly. Now, if we turn to the private sector survey, that showed actually a decent bounce in the manufacturing PMI in August. Again, it is questionable how much weight we can put on these numbers. The Caixin will also be subject to the Chinese censor. And they also showed a weakening in the services PMI, but they showed a very sharp weakening. So their composite also declined to 51.7. Some hard data, Chinese exports fell 8.8% year on year in August, which was slightly better than expectations, but frankly, still pretty awful. And imports also beat expectations, but were still down 7.3% year on year. In summary, we know that the Chinese have stopped reporting youth unemployment because they didn't like the numbers. And I very much question how much weight we can put on the various PMI surveys, but those surveys indicate that services weakened in August and the Chinese economy is weak and weakening. Okay, and on to one chart. Now, I thought this was interesting. Before we went away for the summer, we did a whole segment on the potential impact of the restart of US student loan repayments on discretionary spending. And we wondered then whether US students who had these liabilities would start to reduce consumption in advance of repayments starting in October. Frankly, what I didn't expect was them to start actually repaying prior to October. And that's exactly what they've done. They've started repaying in big size. So these are annualized numbers. So what they've done is they've taken the weekly student loan repayments and multiplied them by 52 to get an annualized number. And you'll see that prior to the pandemic, they were running at what, 100 billion a year? Over the last few weeks, they're running at 150 billion a year. So US citizens with student loan liabilities have started to massively repay them, which may reduce their discretionary spending. So reminder, we went through this calculation in the last episode, and the consultancy Distill estimated that the resumption of US student loan repayments would decrease discretionary expenditure by between 9 and 16%. Now, if we use the figures from the previous chart and estimate using their analysis that discretionary spending in the US is about 3.6 trillion, 150 billion a year annualized would reduce discretionary expenditure by around 4%. However, there's a great deal of danger in using these naive calculations because you're assuming that it's the average person who has been repaying those loans, where it's actually very likely that the people who have been repaying the loans are the people who have saved up the money to do so. And therefore, it's likely that those repayments are coming from savings rather than discretionary expenditure, in which case, all that's happened is that people have taken assets in the form of savings and reduced their liabilities, and that would have little effect on discretionary spending. But going forward, reminder that from October, everyone with a student loan liability in the US will have to start making repayments, and Distill estimate that will reduce discretionary expenditure by between 9 and 16%. Even if it's half that, that is still a decently big effect and will slow the US economy. On to Inflation Watch, Stuart.
Okay, so here are the summary statistics. UK CPI was down 6.8% to 6.8% in July. The core still at 6.9% though. The US coming in at 3.2 core up for CPI, but core 4.7%. Europe more like 5.5 for core, and Japan 3.1 for core. More importantly, I think we've got the meetings coming up, the FOMC 19th and 20th, BOE September the 21st, and ECB September the 14th. I think that's going to be very interesting about whether they just allow these current higher rates to persist for longer, or whether they still try to stamp on the brake.
What would you do, Stuart?
I'm in the hold it higher but longer, and I think you have a chart later which explains why. That if central banks have been looking at waves of inflation, I think they'll be minded to win not just this battle, but prevent a problem developing later.
I agree. I think interest rates are high enough to be restrictive. If you just look at mortgage rates, they've risen so quickly. And certainly in the UK, you are absolutely discouraging investment in new construction, for example. And you know that monetary policy works with long and variable lags. I think it's high enough. Just got to give it time. So keep it higher for longer.
Well, Keith, a few episodes ago, we were discussing the point by Paul Krugman talking about, well, actually, inflation might be coming down really from the past, from the passing of various supply shocks through the economy. And it just struck me that if that was the case, and interest rates haven't made much difference to reducing inflation, conversely, did we need interest rates to be so low in the past? If interest rates are not actually the measure of what is suppressing or increasing inflation. So in my twisted logic, this also suggests that central bankers might be thinking of not wanting to inflate further asset price bubbles by returning to very low, crazy low interest rates. And there might be a sort of prophylactic argument as well for keeping interest rates nothing like the lower levels, the zero interest rates that we saw in the past.
I think, Stuart, we had a discussion a while ago about the natural rate of interest rates, and natural rate of interest rates is a product of productivity. So the higher productivity, the bigger the demand for money to invest in highly productive new enterprises, and the higher the natural rate of interest rates. If productivity is very low, then basically you can't afford very high interest rates because your new enterprise doesn't generate enough profits to pay the interest rate bill. So going forwards, in order to sustain higher interest rates, we need to believe that productivity will rise. And I just don't think that's true. The demographics are against us. And I think that once this supply shock has gone through the system, that we revert to the pre-pandemic norm. Now, there is an argument that we have tighter labor markets because sick people have left the labor force. But I think they're coming back. The sick and the retirees, if you look at the UK, then the number of people on long-term sickness has actually decreased over the last few months. And we've seen from the unemployment rate that people who had retired prematurely have started to come back. What are your thoughts?
Well, I'm not convinced that productivity and interest rates are so closely linked. It seems to me that there are huge pools of capital through the world which are constantly available for speculative and venture investments. And I don't think they're going to be particularly sensitive to whether interest rates are 1% or 3%. But it does seem to me that a 3% interest rate would head off a lot of speculative excess in markets that you're going to get at very low interest rates. So in a sense, I almost hope central banks don't go back to the pre-pandemic very low rates. I think it causes all sorts of distortions.
Well, I think in the coming years it's very unlikely because inflation expectations need to come right back down before central banks can even consider cutting interest rates back down to zero. But when you look at the last few years, when you look at new industries, venture capital, a lot of the new businesses were only made possible by interest rates being at 0%. Essentially, without very low interest rates, a lot of new investment just doesn't become feasible. Now, we can also argue about how much of that new investment when interest rates were at zero was at all sustainable and was just, fantasy. And actually, I wasn't sure whether they got time for this, but we'll do it. Later, we've got a piece on very fast home grocery delivery and whether that whole industry was just a fantasy cooked up by venture capital companies, flush with cheap capital.
Right, back to inflation. US true inflation has actually picked up to 2.7%. So it's definitely stopped falling, hasn't it?
It has, but it's not too bad, is it?
Yeah, well, certainly compared to the UK.
Yeah.
US month-on-month inflation has declined substantially and is now close to the Fed's target. I think, Keith, you were talking about this before. If you're getting 0.2% per month, well, the Fed can live with that.
Yeah.
Oil prices rising again. It's up year on year. So this is obviously going to be a political issue as well for Biden coming into next year's election. We know the sensitivity of the US consumer to gas prices.
Yeah. What I find really amazing about the oil market is just how much it reveals about the decline of US influence in the world. The US used to hold the Saudi Arabia as a key ally, and they'd be able to persuade them to bring oil prices down and increase production. Now, Saudi's just completely ignoring them and is cleaving towards Russia.
So that the rise in gasoline prices from the rise in oil prices is going to feed its way into inflation measures. And here's some stats showing what would happen to inflation if oil prices stayed where they are now. Another big driver, of course, of inflation is housing. However, if we look at an indicator of what's happening to US rents, they now appear to be falling, down 1.2% on this measure. And we've covered previously that the lagging effect of rents into owner's equivalent rent into the US CPI measure, which we can see with a dampened version in the shelter CPI of the effect of US rents. So the point here is that this is likely to be a downward pressure on US CPI. Monetary aggregates, blast from the past here. So this is US M2 is now down by 1 trillion from its peak and is negative year on year. Goldman Sachs are expecting inflationary pressures to rise again over the coming months, but core CPI to continue falling. Some slightly complicated charts, but have a look if you're interested.
Yeah, I think the important chart is the left-hand one. And what the Fed's going to care about is core CPI, the light blue line year on year. Now, the monthly numbers, Goldman Sachs are saying they're going to pick up over the next few months. But we talked previously about the lagging effect of CPI shelter. Well, over the next few months, that is going to help bring core CPI steadily down. So although the monthly numbers will pick up, core will continue to decline on a year-on-year basis.
And further data from Goldman Sachs and their modeling suggests the US labour market is rapidly approaching a level that's consistent with 3.5% wage growth and 2% inflation. So these would support the idea in futures markets of interest rate cuts in the first quarter in the US next year.
Well, why would why would the Fed cut?
Well, I think if you're getting wage growth of 3.5% and allowing for a bit of productivity, that is consistent with 2% inflation. So do you need 5% interest rates? I think that the hope would be that they'd be shaved back.
Okay, so the bull argument is that inflation moderates, and as it moderates, the Fed moderately cuts interest rates.
Also an election year, Keith.
Yeah, that's true.
UK trueflation, well, it has stopped falling like the US, but it's stopped falling at a different level, plus 11% year on year. It's painful in the UK.
Yeah.
Monetary aggregates for the UK also showing some interesting stroke scary data. UK M2 fell year on year for the first time in modern history. So if you believe that inflation is a monetary phenomenon, then inflation, possibly even deflation, coming soon.
Yeah.
Falling UK wholesale goods prices are likely to feed through into retail prices. At least that's been the case historically. And that should be imminent if this relationship continues to hold.
Yeah, this is from Hugh Pill's speech at Jackson Hole.
UK wage growth remains persistent. In your text here, you say you think the construction sector is showing some signs of moderation. I'm not sure I agree with that. It just looks like across the board that wage inflation is strong.
Yeah, way too high everywhere.
Yeah. Vacancies, construction sector vacancies are down from their peak, but they're still reasonably high. And in manufacturing as well. So again, in the same sort of story as we've had in the States, where over the past year or so, we've always been talking about a tight labour market, and we've had the same observation for the UK. That, I think, has to be, you have to have to change that assumption. The peak does seem to have been in terms of how tight the labour market was.
Yeah, but still, by historic standards, a lot of vacancies unfilled.
Mm-hmm. And in services as well as manufacturing. So same story, falling rapidly, but still at a high level. The Bank of England surveys of recruitment agencies suggest that wage growth for new employees has been falling recently, and the hope then is that that would feed through into existing employees later.
Yeah, so new employees lagged by a year is the orange line. Private sector wage growth as a whole is the light blue line, and you hope the two are correlated, but recently they have diverged quite strongly. So you'd hope they'd come back into line.
Fund managers think that inflation has peaked. This is a chart showing the net percentage of fund managers expecting higher global CPI over the next year. That's basically a -80. Ahead of the ECB meeting next week, here's a quick reminder of the pressure that they're under for very weak economic output numbers, but you've got very strong wage growth, and that remains elevated as of the second quarter.
Yeah, and this is the central bank's dilemma. You know, we saw from the PMIs earlier that the Eurozone economy is certainly slowing and may already be in recession, but wage growth is still way too high. So what do? Do they pause because the PMIs are weakening, or do they keep on increasing rates because wage growth is still way too high?
So in summary, oil prices are rising again, and that will tend to cause inflation to rise as well over the coming months. US inflation does appear to be rapidly coming under control despite that issue with the oil prices. And we can see the impact of shelter and rent likely meaning there'll be downward pressure on inflation. A soft landing in the US would mean a slow normalization of inflation. In the UK, wage growth remains way too high, but there is increasing evidence of a slowdown in the labour market, which would bring wage growth under control. And that, of course, would be turbocharged if there was an outright recession. And finally, yes, this is the chart, isn't it, Keith? So the blue line is US CPI from the 60s, mid-60s to the early 80s. And the yellowish line is the CPI experience that we're going through at the moment. And, it's the Twin Peaks problem, isn't it? Rolling in bouts and waves of inflation. So it appears that inflation is under control, but if we go through anything like the 70s, there's another wave coming, and it's a bigger one at that.
Yeah, so Larry Summers, for Treasury Secretary, has been promoting this chart, but I like this.
Yes.
So the FT's point is you can overlay any two data sets and get something like a correlation. It's like, just as, there's no reason at all for you to get such a strong second wave, in analogy with the 1970s, which, reminder, that huge surge in inflation in the late 70s was caused by the Iranian Revolution starting in January 1978. So,
Yeah.
Okay, thank you, Stuart. On to Recession Watch. Well, US corporate bankruptcies continue to rise, and as of July, the total number of bankruptcies in 2023 have exceeded the total for the whole of last year. And the number of bankruptcies has been spiking. So month on month, steadily rising. Personal bankruptcies in the form of credit delinquency rates are also rising steadily. And the default rate on consumer loans is the highest it's been since 2012 and the aftermath of the GFC, and credit card and auto loan delinquencies also very elevated. Auto loans particularly worrying. That is the highest it's been since the GFC. And generally, the last thing people want to default on is their car loan because they need their car to get to work. Now, previously, we were talking about how US students had started repaying their student loans early, and in October, all citizens with student loans will have to start repaying them. Well, other pressures on US consumer spending come from rising interest payments on their debts. And this chart shows interest payments, and as you would expect, rising rates mean rising interest payments, and that will also tend to reduce US consumer spending. The Big Four banks in the US have increased their loan loss provisions to the highest they've been basically since the aftermath of the GFC, although in absolute terms, those do not seem particularly high to me. The Credit Managers Index, though, is falling, and is falling to the lowest it has been outside a recession. So credit is difficult to get hold of. And this chart shows the labor differential in grey versus the unemployment rate. And the labor differential is the difference between the number of people saying jobs are plentiful and the number of people saying jobs are difficult to get hold of. You'll see it is rising. And I think the point is the rate of change rather than the absolute level. Now, turning to the UK, UK bankruptcies are also rising very rapidly. Very low interest rates during the pandemic and fiscal largesse kept lots of zombie companies alive. Well, those zombie companies are now dying. And UK household debt as a percentage of disposable income is actually well down from its highs in the GFC, but is still 129%. So those debts presumably are mainly linked to interest rates, and UK interest payments will also be rising, putting further pressure on UK household budgets. Reminder, monetary policy acts with long and variable lags, and we showed this a few months ago. Apollo estimate that the main impact of the 5% rise in US interest rates won't be felt until Q2 2024. So it's still coming. So in summary, monetary policy works with long and variable lags, and the rapid rise in interest rates will have an increasing effect on the world economy over the coming months. The US is resilient, but the labour market is definitely slowing. The UK economy is slowing and actually may already be in recession, according to the PMIs. And on to the credit impulse. So previously we talked about the credit impulse in narrative terms, but actually you can define GDP in terms of the credit impulse. So if we think of GDP as being the sum of consumption plus investment, therefore, change in GDP, i.e. GDP growth, is a function of the change in consumption and the change in investment. And if we assume investment is funded by debt, then therefore investment equals the change in debt. And so GDP, the change in GDP is the change in consumption plus the second derivative of the change in debt, and that is the credit impulse. And reminder, in the US, the banks have been tightening lending standards for small firms and for medium and large ones, making credit less available, and therefore the second derivative of debt, the credit impulse, has been falling. Now, I have been unable to find data for the credit impulse, and so a bit of original research by Portfolio Matters. I calculated my own using data from the St. Louis Fed. And so this is the 12-month change in the 6-month credit flow. And you'll see this is a chart going back to 1990, highly negative, actually at levels only seen during the Great Financial Crisis and the pandemic. We look at the 12-month change in the 12-month credit flow, not quite as bad, but still pretty awful. So the credit impulse in the US is deeply negative, and we're calculating it for the US because we have data, and that will tend to reduce US economic growth in the coming quarters as credit is spent on new projects, and so the flow of new projects will fall, and credit is not spent immediately. It's spent on new projects over quarters. And so in the coming quarters, that lack of credit will tend to reduce US economic activity. On to soft landing watch, Stuart.
Okay. Well, picking up on bankruptcy, which we covered just a little bit earlier, bankruptcy, unsurprisingly, is usually correlated with high yield spreads. And we can see here in green, the US corporate high yield yield, and in blue, the 3-month average of the number of bankruptcy filings. And now there's become a very big gap between them. You would be expecting high yield yields to be rising in an environment of increasing bankruptcies, but they haven't been. And it's a really quite dramatic gap. So avoid the high yield market, I think, is the simple conclusion from that.
Well, I think that's true. I think high yield is overvalued. But another way of looking at this could be that a lot of those bankruptcies are very well flagged in the form of companies that are essentially zombies, which have been kept alive by pandemic stimulus and very low interest rates. And so the market doesn't think that the rising bankruptcy rate is a harbinger of wider credit issues.
I'm very dubious of that. I think a lot of cans have been kicked down the road and will eventually have to, the chickens in the cans will come home to roost.
Well, I agree with you, Stuart.
Right, we often talked about the issue that a lot of US households have got fixed rate mortgages and they're not going to move because they've got such a good deal. Well, this attempts to measure it by looking at the US bank rate on a new mortgage. So at the moment, a bit over 7%, as we've highlighted in previous charts. But if you look at the effective interest rate on outstanding mortgage debt, it's barely moved. It's just at 3.6%. That's a huge gap to be closed.
Yeah. So essentially, the rise in US interest rates doesn't affect US citizens' mortgages very much. And so they still have money to spend.
Yeah. So it's going to have to come by the corporate sector or by the minority of US consumers who do have to take out a mortgage at this sort of rate. Right. Almost all outstanding mortgages are at below market interest rates. Hence, the tighter US monetary policy is not affecting those mortgages for most homeowners. We can see here that there's just no mortgages with outstanding with a rate higher than the currently available rate.
I thought this is a great chart.
Mm.
Just really puts it in perspective.
Well, yeah, it makes you want to have that sort of service in the UK, isn't it? Imagine a one-way bet, isn't it? Well, you take it out 3% and can never go up if you keep making the repayments, and you've got a free option the other way around. So a soft landing is very much the consensus, but we have been here before. Almost every time there's hope of a soft landing, and then we know what happens next. It's a recession.
Yeah, what I found really striking about this was that, there's peak and soft landing stories, and then followed rapidly by a rise in recession stories.
Yeah, it's like a sort of a Time or a Newsweek headline, isn't it? The instant someone is a hero for either of those magazines, that's the peak.
Yeah.
Right. So soft landing. Well, if there was a soft landing, we would hope for some bounce back in the regional banks, and the regional bank ETF is well up from its lows, but it's not showing a tremendously strong pattern. I mean, it rose from about $37 to over 48. So if you'd have picked the exact bottom, you'd have made a nice turn, but it's now fallen back to more like 44.5. So no second crisis, but no huge recovery.
Yeah, but going back to our discussion from when it was March, when the failure of Silicon Valley Bank, the concern then, and what caused the failure of Silicon Valley Bank and Signature Bank, was the mark-to-market losses on their loan and bond portfolio. And since then, interest rates are higher, particularly medium-term bond rates, which are the discount rates you would use on, medium-term assets. And so you'd think those mark-to-market losses on their existing loan and bond portfolios have only got worse. And what's striking is that regional bank ETF actually has recovered a bit, is not deteriorating despite the rise in bond yields.
Well, how long do you think the average term of a loan is, or the term of a bond that a regional bank might own? Because we're 6 months down the line, so some of their bonds will have matured and they could be reinvested at current prevailing higher rates. I mean, gradually the noose loosens, doesn't it?
Yeah, well, I'd say 5 years, 5-year loan.
Yeah.
So the rates on those have definitely risen, and so their mark-to-market losses have also risen. But as we discussed then, as long as you don't have to sell those assets, you don't have to realize a loss. And it suggests that they have stabilized their financial position and don't have to sell those assets to raise capital.
Expected defaults in Office CMBS are occurring, but there isn't a sort of cascade into other parts of the US financial system. And I think on a similar point, we've seen the news today and yesterday about WeWork trying to unilaterally renegotiate all their leases. So it's hard times in the office property market, but so far the contagion from there has not spread.
Yeah. So only 40% of Office CMBS, commercial mortgage-backed securities, that matured this year have actually been paid off. 60% have defaulted.
Bank of America data shows that US consumers still have much higher bank balances than pre-pandemic. So seemingly some further sort of cushion for most US consumers. And just looking at this, they've broken it down by income, and seemingly it applies across all income levels, but also very much for lower income people. I would have thought they would have spent it first.
Yeah, this is a real puzzle, actually, because we know that the San Francisco Fed and the Fed have estimated that excess savings from the pandemic. In the case of the Fed, they think they're already exhausted. San Francisco Fed think they will be exhausted in Q3, but Bank of America are saying actually bank balances held with them are still way higher than pre-pandemic. Who's right? But we know the default rates on consumer debts are rising, which suggests that Bank of America are not seeing the complete picture.
Again, looking at the soft landing issue, well, according to the Atlanta Fed GDP Now Q3 estimate, a soft landing is nowhere in sight. They're estimating 5.6%. Now, we know that this number is not to be taken totally literally, but it is striking how far it is above the regular economist estimates, which themselves, their estimates have been drifting up as the US continues to defy initial expectations of a recession.
From memory, I remember that in Q2, the Atlanta Fed was about 3.6%. And we reported earlier that actually GDP in Q2 has been revised down to, what was it, 2.1, 2%?
Yeah.
So they were too high in Q2. I very strongly suspect they are way too high in Q3. And if you look at the St. Louis Fed, who have real GDP nowcast, they're saying they expect US GDP in Q3 to actually be negative. So, you know, huge divergence in the forecast of the different Feds.
Okay, so here we're looking at some data from the ISM, where they're looking at new orders minus inventories as a measure of our place in the cycle. And this actually is quite interesting. It's suggesting that, if anything, there's an upswing coming, that the manufacturing cycle has bottomed.
Yeah. So they're saying that actually we're in for a soft landing, that over the coming months, US manufacturing PMIs will improve.
Well, I suppose there's been so many stimulus programs, haven't there, that perhaps they're feeding through into real activity.
I just thing is, all these arguments about soft landing seem to the underlying assumption is that the US can live with interest rates at 5.33% on average.
Yeah, I mean,
And
projections out for the US deficit and debt, it's deeply scary.
yeah, I just don't believe it. You know that interest rates work with long and variable lags, and if we ignore all the noise and just look at the fundamentals of the US labor market, the US labor market is slowing. And that, to me, is the dominant effect. As people lose their jobs, then aggregate spending goes down and consumption is the main part of the economy.
The Fed Beige Book, a survey of economic activity, has come out recently. And in each of the regional branches shows the US is not in recession. So I'm not sure quite how they put that together, but again, it's the same story of US exceptionalism.
Yeah. Actually, if you look at the red line, it bounced back in the last quarter and it looks all right.
Right. Here we go. A soft landing is always expected before a recession, as we were showing in the chart previously. But here, I think it's much more enjoyable. Schadenfreude. 1973, 1978, 2000, 2007.
Yeah, 2007 is a big one.
Yeah. So bottom line, US economy continues to show resilience. A soft landing narrative is a common feature of the early stages of any economic slowdown. Monetary policy, as Keith is talking about, is such a dominating influence. We know it acts with long and variable lags, but how can it be resisted?
And we talked briefly earlier about food delivery apps, and the FT had this great story about the rise and fall of these rapid delivery grocery apps over the last few years, as funded by venture capital. So what this chart shows is the capital invested by venture capital companies, over 10 billion, although it seemed to be, frankly, quite a lot more than that, whichever axis you use, and the discounts they offered to get people to use the service. So the more capital they invested, the more they invested in discounts to get people to download the app and create growth. But as those discounts faded, so the number of app downloads also faded. So in effect, what happened was venture capital piled a load of money into these rapid grocery delivery apps, and by subsidizing them, they created a market. But as soon as the capital ran out, so did activity on the grocery apps. Essentially, it was a big wealth transfer from venture capital industry and their investors to anyone who wanted a tube of toothpaste delivered fast.
Yeah.
And what you see here on this chart is that when the amount of capital started to run out, so the number of discounts app offered rapidly fell. Essentially, they're running out of money and they couldn't stop subsidizing the service. And because it's venture capital, despite the huge fall in activity and app downloads is the yellow line here. When you look at the valuations that the venture capital industry is putting on these businesses, they've hardly fallen at all. So the blue line is the aggregate amount of capital raised. The yellow line is the valuation of the entire industry. And so the activities disappeared, the valuations remain elevated. And onto other charts, Stuart.
Right. I thought we were going to be doing good news, but we're not. We're still on bad news. Annual CO2 emissions. This is from Our World in Data, I believe. You look at China here, it's just going through the roof. And I know they're promising all sorts of things with their rollout of solar plants, etc. But the reality on the ground, day to day, is the emissions are showing absolutely no sign of peaking. The United States does seem to have peaked and is coming down. India is on a China-like trajectory. It's difficult to be optimistic when you see these sort of quantums because, well, yeah, there's so much to be done.
Yeah, when all these climate protesters in the UK, it's just a pointless social activity. The reality is, whatever we do in the UK, it's tiny compared to the impact of China and India burning lots of coal and building lots of coal-fired power stations.
Yes, the only answer is a global coordination, and how likely is that? Right, 30th warmest summers globally. Well, here we are. It's this one, isn't it? So by far the hottest summer since records began this year.
Yeah, I thought this was really interesting. When you and I were growing up, Stuart, like back in 1987, yeah, the summer then was 16 degrees C. It's like 0.75 degrees C higher.
I was having a look at 1976. That was a famously hot one, wasn't it? But
yeah.
It's not even on the chart. Right. Have we moved off from bad news to good news? Well, not really. Global central bank balance sheets, they are shrinking a bit. So QT is happening, and that will be at the margin tightening financial conditions and reducing liquidity. Being done, it has to be done gently, gradually, to avoid accidents. Here we are, it's happening. But let's have a look at the Bank of Japan, for instance. They've been the exception, haven't they, with continuing to print money? Yeah. Right, this is the problem for the US retail sector in one chart. This is department store sales quarterly since the year 2000. And that is a grim chart, isn't it?
Yeah.
This, I'm assuming, is not even inflation adjusted. So we've gone from almost 60 billion in annual sales to less than 35. My goodness, if you own a store let out to a department store, you're going to be deeply worried, aren't you?
Yeah. Yeah. People's buying patterns are changing. So much is going online now. The department stores are, and frankly, high street retail is just being hollowed out.
Yeah. Right. A weak Chinese yuan is not attracting quite the much attention that it did a few years ago, but it could be a route to disinflation for the rest of the world if they keep exporting goods to everybody else.
Yeah, I agree. It's an obvious play for China. Their economy is weakening. They weaken the yuan. Price of Chinese exports falls, and they export more.
Yep, given how difficult everything is in the property sector and the consumer sector.
Yeah.
I was reading a sort of throwaway remark in a newspaper talking about Xi Jinping's personal experience of being sent to the countryside during the Cultural Revolution. And the argument this guy was making was that this had actually left that Xi Jinping with a view that consumer consumption is a bad thing. It's waste, and that we can tough it out. And there's a morally superior approach to not consuming. So he's got a preference for industrial activity for exports and to avoid domestic consumption. And therefore, there won't be the support of the Chinese consumer that you might hope for.
Interesting. So, in summary, he thinks that foreigners consuming Chinese goods is good, and Chinese people consuming Chinese goods is bad.
Yep. Bloomberg Economics is forecasting that Chinese growth will fall to just 3.5% by 2030, 2.8% by 2040, and 1% by 2050. Obviously, China is a massively interesting case study, industrialized so fast, but now the population is shrinking. How is this all going to play out? China debt position. This is a very good chart, I think, because we tend to think in debt in terms of central government debt, which in China isn't that big, but it's debt in so many other parts of the economy that's the worrying part. So non-financial corporations, look at that chart on the left. That's the largest single part. Households, that's been growing. Debt as GDP, percent of GDP. Quite consistently. And I think that the issue that a lot of people are focused on at the moment is local government debt. And given their reliance on the property market and property sales, the difficulties local governments are facing. So arguably the central government has got the capacity to help out local governments, but the overall debt burden is, or debt situation in China is now 300% of GDP. So the hope, I suppose, is you're in a closed system, but the possibility or the potential for an accident, a crash, as is seen in so many economies as they industrialize after property bubbles, looks really quite a high probability to me.
Yeah, absolutely, because it's the speed with which that debt has accumulated. That implies very large annual investment numbers. And whenever that's occurred in history, you have tended to have massive malinvestment. You think of the Asia crisis. Every country that's had such a rapid buildup in debt has invariably had a financial crisis of some kind. It's very difficult to predict the timing of that crisis, but it's pretty likely you're going to have one. Thank you, Stuart. On to good news. And it's nice to have a bit of good news this week. Well, Bloomberg were reporting that there has been an aerial survey of this big national park, this Transfrontier National Park, which covers a region the size of France and is spread over 5 countries: Angola, Botswana, Namibia, Zambia, and in Zimbabwe. And they have found 228,000 elephants just in that region of Africa. And they estimate that the elephant population has grown by about 5% since they last did the survey back in 2016. So that is all good news. Elephants seem to be doing pretty well. However, they also found a lot of elephant carcasses, which suggests that the elephants were suffering from stress. But net, the elephant population is growing, which is a great thing. And on to equities, Stuart.
Okay.
Sorry, actually, before you go, can I just say that all the weekly change numbers and last week actually refers to the last time we did Portfolio Matters, so about a month ago.
Okay. So turning over to the overall world equity index, down just 1.3%, not too much of a change, reasonably modest in the context of the volatility we've seen over the year. So we're now up 11.5% for the overall world equity index. FTSE All Share has not contributed to that at all. It's down 0.5% for the year and 2.5% since the last edition of the programme. Euro stocks 6.8% for the year, down 2.2% while we've been away. The S&P 500, well, yeah, this is the main driver of the overall world equity return. S&P up almost 16% year to date, off a bit, 0.6% since we last broadcast. The Nasdaq, as we've been covering in previous episodes, this is the turbocharged source of the main gains in equities, up 31% year to date, and over the past few weeks down just 0.3%. The Hang Seng, 8% down for the year, making the UK look like a bolt hole of a safe haven, and it's actually been quite weak recently, down 4.8%. Topics has had a very good year, certainly in yen terms at least, up 26%, and since we've been away, it's up 3.4%. It has to be pointed out that for non-Japanese investors, this has got to be diluted by the weakness of the yen. Bitcoin, that has taken a bit of a kicking. Not quite sure why that is, because a possible Bitcoin ETF seems to have got through some regulatory hoops. I thought that would be helping it, but since we've been away, it's down 12%, though still up 56% year to date. Pound to the dollar has come off. We were referring to the possible peak in UK interest rates, so it's down 1.8% since we've been away, up 3% on the year though. Euro to the dollar has been even weaker, off 2.7% since the last show, flat on the year. The dollar index is showing quite a bit of life. It's risen from about an index level of 100 in the middle of July, pretty consistently. It's now at about 105, so quite a bit of dollar strength. The VIX continues to be very low. I think both Keith and I would love to bet on this rising if there's any rational way of doing it, but there isn't. Be very careful in any product offering the opportunity to make that bet. Year to date, it's down 30%, but I mean, this level of just around 15 is strikingly low.
Yeah, particularly given the volatility in bonds and the amount of economic uncertainty. It's amazing. What it implies is that equity investors are complacent, frankly.
Yep. Fear and greed. Okay, well, this is not showing the extreme readings that we saw earlier at the early part of the summer. We're now pretty much on neutral. Technology, another measure, not just the share price performance, but sector flows has been the absolute standout this year. This is data as at the end of August, showing that all the flows basically have been into tech and have been out of energy. So performance chasing, momentum chasing.
Yep.
There is a strong inverse correlation between the S&P 500 and the Chicago Fed National Financial Conditions Index. So these financial conditions indices need to be looked carefully to know really which way round they are, whether a rising number is tighter or looser. So the logic here is presumably looser conditions driving the market up.
Yeah, but actually, I think the correlation could be the other way around. The narrative could be the other way around, causality, in that, we know the Chicago Fed National Financial Conditions Index is derived from market numbers. So complacency in the market leads to the Chicago Financial Conditions Index being very weak.
So something reflexive, something differential there. Yeah. Which I think is the point you're making here in this chart, isn't it?
Yeah, but it's striking that, we've had tightening interest rates and rising bond yields, and actually the financial conditions index is loosening.
Well, I suppose spreads are quite tight, aren't they? We saw that with the high yield bonds.
No, amazing.
Oh, right. Yes, the chart that will not die. Central bank balance sheets and equity markets. Now, we used to see this particularly in relation to between the Fed and the S&P 500. Someone's created a different one here. So we've got the Fed, European Central Bank, and the Bank of Japan's balance sheet against the NASDAQ 100. So even on this measure, the NASDAQ is looking dodgy, is looking at risk because central bank balance sheets are beginning to be pared back, but the NASDAQ 100 is still going for the moon.
Yeah. Thing is, I've just questioned whether this is a real correlation at all. I put in this yellow circle. You see, over that period, 2017 to 2020, there was no correlation between them at all. So,
yeah,
skeptical. Anyway, thank you, Stuart. On to commodities and energy commodities. Well, Brent has shot up on the back of the OPEC news, tightening oil market, and as you'll see in a minute, the EIA are forecasting that the oil market has now moved from surpluses in the first half to deficits in the second half. And that big rise in oil prices will feed through to higher inflation. But you have to question why OPEC Plus feel the need to take barrels off the market. Presumably, they think underlying demand is weak. And if we do have a recession in developed markets, then the oil price would weaken again. This is WTI again shooting up, and the highest level it's been this year. Some numbers specific to the oil market. Well, big drawdowns in the period we were away, excluding the Strategic Petroleum Reserve. The US got through 18.4 million barrels out of storage. So over the period, the US oil market was undersupplied. Now, good news is that US crude oil production picked up by another 200,000 barrels a day over the last few weeks we were away, to a new high of 12.8 million barrels a day. And that is up 800,000 barrels on the year. And frankly, there seemed very little sign of strong US production growth over the first half of the year. But as our oil export on the Discord, Simon W, is always saying, the US shale production is a function of technology. And as long as they can keep on producing the technology and increasing recovery rates, then you could see stronger US oil production despite a falling rig count. And that is exactly what we're seeing. Okay, so the EIA is forecasting that the oil market will move from over to undersupplied in H2 to to the extent of around 400,000 barrels a day. Now, at the start, we were talking about how Rystad Energy are forecasting much bigger drawdowns of, I think from memory, over 2 million barrels a day in the second half. But either way, the oil market is going to be tight in the coming months. And as evidence of that, you can see the solid blue line, US oil inventories are steadily falling. So the US market is undersupplied. Moving on to natural gas, well, great news for Europe. European natural gas futures fell by best part of 11% while we were away, and are down 56% year to date. UK, similar picture. Great news for UK inflation and UK consumers. US natural gas futures also fell and down 41% year to date. Coal, however, followed oil up 12% in the time we were away, but still down 6% on the year. Uranium, the bull market is back on, up 7% over the last period, 24% year to date. Stuart, industrial metals.
Okay, aluminium showing no signs of life, down 1% while we've been away, off 8% year to date. That looks completely dead. Cobalt, well, I don't think the data's been updated here, really, has it? So
yeah,
the main issue there is it's down 35% year to date. Copper, we've referred to before as Dr. Copper. That's not looking good, is it? Down 0.5%, 2.4% for the year. Chromium up 0.8% while we've been away, still off 9% for the year. Iron ore has shown some life, up quite a bit, about 15.5% while we've been away, now pretty much flat for the year.
Yeah, I was really, really surprised by this. So I have included the commentary from Trading Economics on the chart. If you're interested, please pause and take a look. Bottom line is, they're saying that Chinese steel mills are going to be ordered by the state to produce a certain amount.
Lithium continuing to come off well, my goodness, down 20% while we've been away, down 62% year to date. Well, we knew the lithium story had faded, but it's faded after even more after that, hasn't it? Neodymium, showing some signs of life, up 13% while we've been away, still off 34% year to date. Nickel, I think pretty much like aluminium, very little happening. Changed of just 1% while we were away, still off 32% year to date. Tin, same sort of picture, off 3.6% recently. Ferrovanadium, down 3.1% over the past couple of weeks and off 16% for the year.
Yeah, you'd expect ferrovanadium to be very highly correlated with iron, but it's not. It's that it's sold off while iron ore is shot up. Reminder, adding 1% vanadium to iron doubles its strength.
Zinc showing a bit more life than the aluminium had been. It's up 16% over the past couple of weeks. That must be a particular bottom to a particular top, because it doesn't seem to have really broken out from the range since May, June time.
Yeah, I think that's recent trough to now.
All right, turning to precious metals. Gold, not largely unchanged over the past couple of weeks, down by 0.4%, up 5% for the year. Silver, a little bit more volatile, off 3% over the past couple of weeks, off 4% for year to date.
Yeah, but the thing is, so all these prices are in dollars, and we know the dollar's strengthened. Also, yields have shot up. So I think the safe haven status of precious metals, they've done pretty well in the circumstances.
Well, I suppose there has been a lot more commentary about the unsustainable US debt dynamics. Perhaps there is some sort of move to the safe haven idea, and we know quite a few holders like the Chinese are beginning to just slowly, gradually back off from their treasury holdings.
Yeah.
Platinum down 2% over the past couple of weeks, off 15% year to date. Rhodium, well, I suspect no data update there. That's been completely flat over the past month or so. Palladium, my goodness, that's just dribbling off and looking very unattractive, off 4% over the past couple of weeks and off a third for the year to date.
Okay, thank you, Stuart. On to rates, and it's been an extraordinary period in the bond market. So this is the UK, and the dark blue line is the current yield curve. The dotted line is yield curve a month ago. Now, we know that the UK economy is slowing, inflation is coming down, but bond yields have risen. So something very odd is going on. It's caught me completely by surprise. And I think it's driven by the US, where we know that Janet Yellen is, as the US Treasury Secretary, is issuing vast amounts of treasuries. I believe total treasury issuance is going to be something like 1.9 trillion. Is it this year? Or was it this half? Anyway, it's enormous. And the US rate, and the US bond market appears to be suffering from indigestion. So in order to sell all those bonds, the US government is having to offer higher rates. And as a result, although US inflation is coming down and heading towards the 2% target, as we have discussed, rates have been rising and are at astonishing levels compared to inflation target of 2%. So you're now talking about a US 30-year, which is yielding almost 2.5% above 2%. So when you think about not so long ago, US 30-year rates were below 1%. That is an absolutely huge move. Now, I believe that is going to have massive knock-on effects for investment and economic activity. What this chart shows is that financial conditions in the US have tightened substantially over the last month. So if you want to get a loan out from the bank or fund your new project, you've got to pay a lot more. And so investment can be expected to decline, and that should feed through to lower economic activity. But what's absolutely true is that bond investors have got absolutely stuffed, me included. And this is the performance of the US Treasuries ETF. And when you look peak to trough, it is more than halved over the last few years. And if you're a bond investor thinking that government bonds are a good safe haven, well, you've been wrong. And the US Treasury market, bonds are just about to record 3 years of negative returns for the first time in history, going back to 1787. Now, what's interesting is that bond yields and economic activity appear to have completely decoupled. So the grey line is the US 10-year bond yield, and the red line is global manufacturing PMIs. And you'll see they tend to be well correlated until recently. Now, if you believe that the US and the world economy is slowing down, then that should mean that bond yields come down as economic activity falls. And that, frankly, is my belief. But something I knew and ignored to my cost is that it is safest to buy duration when the last rate hike is in. Now, I anticipated that and have got that completely wrong when the US economy showed unexpected resilience and the Fed kept on raising rates longer than I possibly imagined. And as a result, bonds have had a very bad period, as have I. But what this chart shows is that in a recession, bonds tend to outperform, stocks tend to underperform. And so I still think higher interest rates lead to lower economic activity and a recession in the US in the EU and the UK. We are definitely seeing that. In the US, I think we will see it. So I would be very wary of stocks, and I think that bond yields are very attractive currently. And this just shows that stocks are very expensive compared to bonds. The equity risk premium is at 16-year lows. Okay, talking about yield. So this is the UK 2-year. It's come down today as world equity markets have had a bad day, but over the last month is up. Is that peaking? Let's hope so. UK 10-year, similar story. UK 30-year, similar story. The US 10-year, despite falling US inflation, that is close to peak. Germany, similar story. Italy actually really hasn't gone anywhere. This reveals the impact of ECB bond buying. The Italian bond market is essentially a function of where the ECB wants it to be, and same for Greece. Stuart, any thoughts on equities, bonds, or asset allocation?
Not really. No changes. My strongest conviction, which has been wrong, is to within equities to avoid the US, primarily based on valuation grounds, and to buy the world ex-US. I'm not as ballsy as you in terms of making a big swing between equities and bonds, but within equities, the valuations just don't make sense to me for the US equity market. And as we covered a few weeks ago, the fact that the US is now 70% of the world index, it just strikes me as sort of nosebleed impossible.
Yeah.
I'd rather maintain a diversified portfolio, so I do want some equities, but I just can't buy much US. I'm holding world ex-US primarily, and it's obviously been wrong.
Yeah, but I think both you and I have a value bias, and I just find it impossible to buy, Nvidia at 240 times earnings, or actually, prospective earnings is only about 50, but still.
Yeah, exactly. But no change overall to my overall asset allocation.
Well, none to mine either, although I've had a terrible year and I've been completely wrong so far. Okay, concluding comments. Well, the US labor market does appear to be slowing, but the US economy continues to be resilient, and the market certainly believes in a soft landing. US inflation is coming down and appears to be on a path towards the Fed's 2% target, despite the recent rise in oil prices. According to the latest PMIs, the UK and EU economies are close to or in recession, and you expect their economies to slow further as the lagged effect of the massive rise in interest rates begins to take effect. But in both the EU and the UK, wage inflation is still way too high to be compatible with the 2% target. So what will the central banks do? The ECB meets next week. The Bank of England meets 2 weeks after that. Let's wait and see. Stuart, how have you been doing?
Well, I haven't given a slide here because basically it's unchanged since the last time I was on, which is that I'm having a limp year. I'm down about 1%, and I've been impacted very much by the same macro issue as you, Keith, i.e. rising rates, but it's impacted me by my holding in infrastructure funds and green energy funds and REITs, all of which have been weak as rates keep rising. My hope is that in all of those areas, there will be dividend growth, and that will be fighting against the rise in yields, if you see what I mean. That if you've got a green energy fund increasing its dividend by 5 to 10%, an infrastructure fund by 2.5 to 5%, that will keep pushing up the yields, and irrespective of change in the overall macro yield environment, that mathematically you'll have to begin catching up at some point. And if rates begin to fall, then that could be, receive a double kicker, with rates falling on or discount rates falling on infrastructure funds and green energy funds and REITs. So I'm sharing your pain, not perhaps quite as bad as it's the pain you're going through, but from the underlying same cause. I think only Richard is having a decent year.
Yeah. Well, thank you, Stuart. I'm having a truly shit year. And I obviously have got this completely wrong. And currently, I'm having, I think, my worst year ever. I thought that the turn in UK inflation and the signs that UK inflation was actually falling quite rapidly would lead to falling bond yields. And before I went on holiday, I added to my bet. And then I was completely caught out by the big rise in bond yields across the world. And in the period I was away, I actually lost an enormous 5.3%, taking me down to 13.7% negative on the year. And frankly, not looking very clever. I play the cycle, and the bottom line is the cycle hasn't turned. For somebody whose strategy essentially depends on market timing, I am remarkably bad at it. It always seems to work out in the end, but is immensely stressful. And I think this has just about been my worst timing ever. So no buys, no sells, because essentially I've fully committed, which is silly because I didn't think that UK bond rates, UK interest rates could get anywhere near where they are now, because of the outstanding stock of debt and the increased interest payments that will result from interest rates as they are now. I should say that there's been a bounce today, which is not included in those figures, but you get the idea. I've lost a lot of money and I'm not looking very clever, and frankly, not feeling very clever. But where we are now is you can buy the T68 2068 gilt with a real yield of 1%, which would be tax-free capital gains, and implied inflation of 3.5%. So I don't think we are going to get UK inflation of 3.5% for the next, 40 years, 45 years. So I'm very happy to hold at these levels. I think this is just absurd. But mark to market, I'm not looking very clever. My son was having a go at me the other day for taking too much risk. And as I said to him, I have quadrupled my money over the last 15 years. And you don't get that by putting it in an index fund. But the bottom line is, when you get it wrong, it's painful, and it's painful. Reminder that the price of the T68 gilt peaked at 325 less than 3 years ago. And I think that when the UK enters in recession, I'll probably be all right. But it's not been much fun, and I've been way too big, way too early. There will be a my worst trade coming out on this in due course. Anyway, thank you all for watching. I hope you're having a better time than I am. Thank you to Stuart for subbing for Richard, who is on holiday in France. We are now back and will resume our usual weeklies for the foreseeable future. Thank you all for watching and for making it through to the end. Please can you press like and subscribe to the channel, and it's goodbye from Stuart Owen.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.